Has the oil price trend changed? Yesterday, oil prices dropped as China's energy consumption decreased amid a lockdown in Shanghai, the largest production and logistics center. Today, the quotes have already pared all yesterday's losses. First of all, this growth can be attributed to the fact that China has eased some lockdown restrictions, and this means that oil demand in China, the world's largest buyers of commodities, will soon recover. Market participants also priced in OPEC's warning that it would be almost impossible to replace Russian oil, and sanctions on Russia could create one of the worst ever oil supply shocks. On the oil embargo on Russia is still on the table, and in the case the European Parliament imposes this ban, the market will face a shortage of 7 million barrels per day in oil supply. Against this background, oil prices have reached the levels seen before the start of Russia's special military operation in Ukraine. Yesterday, Brent crude oil once again hit a new local low, sliding below $98 per barrel. Technical analysis experts argue that despite today's rebound, market sentiment is still bearish. The area between 97.00 and 97.60, the local low of March, acts as a variable support level. Thus, if the price fixes below $97 per barrel on the 4-hour chart, a signal of a trend change will come. And in this case, the asset will most likely fall to the level of 90. As for the medium and long term, an uptrend prevails in the market. Yesterday, the ruble continued Friday's long-awaited correction from extremely overbought levels following a prolonged period of price gains. From a technical point of view, the US dollar has fairly strong upside potential. The quote may well return to the area of 85 and 88 rubles. However, the dollar-ruble pair is still trading under pressure from exporters who are forced to sell the currency, as well as from the news flow. Therefore, there is no point in relying only on technical analysis. Besides, the greenback is gaining value in anticipation of a US inflation data to be released today. Actually, this is what keeps gold near the upper boundary of the previous trading range. There are growing fears of accelerating consumer price growth, which reinforces expectations of a more aggressive Federal Reserve tightening. Thus, the Fed may raise its interest rate by 50 basis points at once at the next policy meeting. Speaking of technical analysis, gold futures managed to locally pierce the upper boundary of the 3-week sideways channel at the level of $1,966 per troy ounce. This led to a decline in the volume of long positions and then a pullback. Despite bulls' unsuccessful attempt, the market may well see a trend change. To confirm this signal, the quote needs to consolidate above the $1,975 mark on at least the 4-hour chart. And that's all for now. We continue to learn developments on financial markets. Subscribe to our channel and follow news with us. See you soon.